Hey, welcome back. There is a massive difference between knowing what on-chain metrics exist and knowing how to actually use them the way professionals do. Most retail investors who get into on-chain analysis make the same mistake. They learn about a metric, see one interesting chart, and treat that single data point as a trading signal. They check MVRV once, see a number, and make a decision based on that one snapshot. Professionals do not work that way at all. Professional investors and analysts treat on-chain data as one input into a larger, structured decision-making process. They combine multiple data sources. They look for confirmation across different metrics. They understand the limitations of each tool, and they build repeatable workflows rather than reacting to individual numbers in isolation. Today, I'm going to show you exactly how professionals actually structure their use of on-chain data. Not just what the metrics are, but how they are combined, weighted, and applied to real investment decisions. This is the missing piece that separates people who know about on-chain analysis from people who actually use it effectively. Let us get into it. Professionals start with frameworks, not metrics. The first thing that separates professional on-chain analysis from retail on-chain analysis is this. Professionals do not start by looking at random metrics and seeing what they find interesting. They start with a specific question they are trying to answer, and then they select the specific metrics that are most relevant to answering that exact question. This sounds simple, but it is genuinely the biggest difference in approach. Here is what this looks like in practice. If the question is, are we near a market cycle bottom? A professional analyst pulls a specific cluster of metrics known to be relevant to cycle bottoms. MVRV ratio relative to historical bottom levels. Percentage of supply in loss. Realized price relative to current market price. Long-term holder supply trends. Exchange outflow patterns. These are the metrics that have historically shown meaningful patterns at previous cycle bottoms. So these are the ones examined together. If the question is this specific altcoin showing genuine organic growth or speculative hype? A completely different set of metrics becomes relevant. Active address growth relative to price growth. Developer activity on GitHub. Total value locked trends if it is a decentralized finance protocol. Token holder concentration. These metrics speak directly to the specific question being asked. This framework first approach prevents one of the most common mistakes in on-chain analysis, which is finding a metric that confirms what you already wanted to believe and ignoring everything else. When you start with a clear question and a predetermined set of relevant metrics, you are forced to look at the complete picture rather than cherry-picking whatever supports your existing bias. Before you open any on-chain dashboard, professionals ask themselves what specific question they are trying to answer. That question determines which metrics actually matter for that particular analysis. Professionals weight metrics by reliability and time frame. The second major difference in professional on-chain analysis is understanding that not all metrics carry equal weight, and that different metrics are reliable over different timeframes. Here is how professionals think about this. Long-term structural metrics like realized price, MVRV ratio, and hodl waves are extremely valuable for understanding broad market cycle positioning, but they are nearly useless for short-term timing. These metrics can stay at extended readings for extended periods. MVRV being historically low does not mean the bottom is happening this week. It means the broad conditions associated with previous bottoms are present, which is a completely different statement. Professionals use these structural metrics to answer the question, what kind of market environment are we in, broadly speaking? Are we in a zone historically associated with accumulation opportunity, or a zone historically associated with distribution risk. This shapes overall portfolio positioning and risk tolerance over a period of months, not the timing of any specific trade this week. Medium term metrics like exchange flows, SOPR, and active address trends over multiple weeks are more useful for identifying developing shifts within that broader environment. These metrics can show meaningful changes over days to weeks, helping refine timing within the broader structural picture established by the long term metrics. Short term granular data like individual whale transactions and daily exchange flow spikes are treated with much more caution by professionals. A single large transaction or a 1 day spike in exchange inflows is noted but rarely acted upon in isolation, since this level of data contains enormous noise relative to genuine signal. The professional workflow moves from broad to specific. Establish the long-term structural picture first using the most reliable, slow-moving metrics. Then layer in medium-term trends to refine understanding within that picture. Only then consider short-term granular data points, and even then only as minor inputs rather than primary decision drivers. This hierarchy prevents the common retail mistake of overreacting to short-term noise while ignoring the much more reliable long-term structural signals that actually matter most for significant decisions. Professionals look for confirmation across independent metrics. The third critical professional practice is requiring confirmation across multiple, genuinely independent metrics before drawing significant conclusions. This is different from simply looking at many metrics. It specifically means looking for metrics that measure fundamentally different things. Since metrics that are essentially measuring the same underlying behavior in different ways do not actually provide independent confirmation of anything. Here is a concrete example of how this works. Imagine you observe that MVRV has dropped to a historically low level. This alone suggests the market broadly is near previous cycle bottom conditions. But professionals do not stop there, because MVRV alone could theoretically be showing a misleading reading due to unusual circumstances specific to that moment. A professional looks for independent confirmation. Is the percentage of supply in profit also at historically low capitulation level readings? This measures something related but distinct. Are exchange reserves also showing sustained outflows, indicating holders are choosing to accumulate rather than sell despite the low prices? This measures a completely different type of behavior. Is active address data showing stabilization or growth despite the low price, suggesting renewed organic interest? This measures network usage, a third independent dimension entirely. When multiple genuinely independent metrics, each measuring a different aspect of market behavior, all point toward the same broad conclusion simultaneously, the confidence in that conclusion increases significantly. This is fundamentally different from one metric alone, no matter how compelling that single metric might look in isolation. This is also why professionals are inherently skeptical of analysis built around a single impressive looking chart. A single metric showing an extreme reading makes for a compelling social media post, but professionals understand that genuine conviction requires multiple independent lines of evidence converging together, not one cherry-picked chart that happens to look dramatic. Professionals combine on-chain data with other analysis types. The fourth professional practice involves understanding that on-chain data is one analytical lens among several, not a complete standalone system. Professional investors combine on-chain analysis with at least two other major categories of analysis, using each to inform and check the others.
The first additional lens is technical analysis, meaning price chart structure, support and resistance levels, and broader market structure patterns. On-chain data tells you about underlying holder behavior and network fundamentals, but technical analysis tells you about actual price action and market structure, which on-chain data alone does not capture. A market can have genuinely bullish on-chain fundamentals while still being in a clear technical downtrend. And understanding both perspectives prevents premature positioning against a technical trend that has not yet confirmed a reversal. The second additional lens is macro analysis, meaning broader financial market conditions, monetary policy, interest rates, and overall risk appetite across global markets. On-chain data exists within this broader macro context. Genuinely bullish on-chain conditions can be overwhelmed by significant macro headwinds, such as aggressive monetary tightening or a broader risk-off environment across financial markets. Professionals do not view on-chain data in a vacuum, separate from the macro environment it exists within. Here is how this combination works in practice. On-chain data might suggest Bitcoin is in a historically favorable accumulation zone based on MVRV, realized price, and supply and profit metrics. But if technical analysis shows price still in a clear downtrend with no signs of structural reversal, and macro conditions show tightening monetary policy creating broad risk aversion, a professional would likely wait for additional confirmation rather than aggressively positioning based on on-chain data alone. The professional approach treats on-chain analysis as one essential voice in a larger conversation, not the only voice making the final decision. Professionals build systematic, repeatable processes. The final professional practice is building a systematic, repeatable process rather than performing ad hoc analysis whenever curiosity strikes. Professionals typically maintain a structured dashboard or checklist they review on a consistent schedule, rather than randomly checking different metrics whenever something catches their attention on social media. This systematic approach typically includes a defined weekly or monthly review covering the same core set of structural metrics every single time, ensuring consistent, unbiased tracking over time rather than selective attention driven by whatever happens to be trending in crypto discussion at that moment. It includes documented historical context, meaning professionals track how current readings compare not just to recent history, but to the equivalent point in previous market cycles, building genuine pattern recognition over multiple cycles rather than reacting to each new reading as if it exists in isolation without historical precedent. It includes predetermined thresholds and reactions, meaning professionals decide in advance what specific combinations of readings would actually change their position or strategy, rather than deciding reactively in the moment when emotions and current price action might cloud objective judgment. This systematic discipline is ultimately what separates professional on-chain analysis from retail on-chain analysis, far more than access to better tools or more advanced metrics. The data is largely available to everyone for free. The professional edge comes from the structured, disciplined, repeatable process applied consistently to that data over time. Let me bring this together. Professionals start with a specific question and select relevant metrics deliberately, rather than randomly browsing dashboards for anything interesting. Professionals weight metrics by reliability and time frame,
using long-term structural data for broad positioning and treating short-term granular data with appropriate caution. Professionals require confirmation across multiple genuinely independent metrics before drawing significant conclusions, rather than building conviction around a single compelling chart. Professionals combine on-chain data with technical and macro analysis, understanding it as one essential lens within a larger picture rather than a complete standalone system. And professionals build systematic, repeatable processes with consistent schedules and predetermined thresholds, rather than performing reactive, ad hoc analysis driven by whatever is trending at the moment. Here is the core insight I want you to take away. The tools and the raw data are available to everyone for free. What separates professional results from retail results is not access. It is process, discipline, and structured thinking applied consistently over time. You now understand exactly how that process works. The next step is simply building the habit of applying it consistently. If this video gave you a genuinely clearer picture of how professionals actually use on-chain data, please hit the like button and subscribe. Drop a comment below and tell me which part of this process you are going to start applying first. I read every comment. I will see you in the next one.